Well, all right, we're up to lesson 11, the statement of cash flows in this financial accounting series. Let's start this one with an example. If we look at this company, and this is Best Buy right here, we can see that its revenue is actually going down a little bit year over year. So Best Buy has a year end of the Sunday closest to January 31st every year. So February 3rd, 2024 is that most closest year end. And with a decrease in revenue, they are seeing a decrease in net earnings. So it's worth looking at whether or not Best Buy is going to be having cash flow issues. We can see that over the last year, the cash went down from $1.8 billion to $1.4 billion. If we wanted to drill in a little further, we could see a line called cash provided by operating activities. 2 years ago, it was $3.2 billion. Last year, it was $1.8 billion. This most recent year, it was $1.4 billion. And we can see that it's going down, but they are still generating some cash flows from their operating activities, their core operations. Cash flows used in investing activities is they're using a little bit less cash each year. And then cash flows used in financing activities is also going down each and every year. Now, what does all this mean? That's what this video is going to be meant to show you. Really, how do we interpret something like this? And their total cash going down a little bit year over year. So in this video, we're going to dig into some details behind that kind of stuff. We're going to recognize the purpose of the statement of cash flows in its three main sections. We're going to calculate the changes in each section, create a statement of cash flows, and interpret the statement of cash flows as well. So first, define the purpose of the statement of cash flows in the three main sections. Why do investors care about cash flows? Well, the phrase that I often hear used is cash is king. That's effectively meaning that cash is the most powerful thing. Go to the store this weekend, go to a restaurant, go to the grocery store, and try to hand someone a piece of paper that says net income to pay for your meal, to pay for your groceries. They're not going to be sure what to do with it. They're going to ask you where your money is. You need cash at the end of the day. The income statement shows accrual basis accounting, but we really want to understand what happened to cash during that period. So it's possible for the income statement to show net income, but the statement of cash flows could actually show that cash went down, or vice versa. If we dig in further to the statement of cash flows, we'll be able to see where the company is spending its money, and the different sections will explain results for the investors. Is the company generating positive cash flow that can eventually be paid to shareholders? That's why companies are in existence, right? So they will need to provide returns to their shareholders. And if they can't do that, they'll ultimately go out of business. The three sections that we're going to dig into. The most important section is probably the operating activity section, cash flows from core operations. If you can't generate cash from core operations, you're not going to stay in business. Cash flows from investing activities, purchasing and selling investments or long-term assets. And then financing activities, which are going to be transactions with your owners and your creditors. So the sum of these three sections is going to equal the change in a company's cash balance for the year. So when we were looking at that Best Buy example, why did its cash go down a little bit over the years? We could have summed that up by looking at these three sections. Now, the direct versus indirect method. So under the direct method, the companies show all the cash inflows and outflows. So as an example, they would show cash received from customers, cash paid to suppliers, cash paid to employees. That would be fine to see it that way. Part of the issue is that information is not readily available in the other financial statements. So we're instead going to use the indirect method. Once you get done with your income statement and balance sheet, you've got everything you need to do the cash flows under the indirect method. You're going to start with net income and then reconcile net income to the change in cash flows. There's things like depreciation, receivables, and accounts payable, which when you have those items, that doesn't necessarily impact cash flows the same way it would net income. What do most companies use? Almost all companies use the indirect method. I personally have never seen the direct method, listed in the statement of cash flows. If if I've ever seen it, it's more when a company is doing its budgets. Well, the first review question, which of these is not one of the sections in the statement of cash flows? If you look at that one quick, which one of these would you say is not one of the sections in the statement of cash flows? Well, investing, financing, and operating activities, those are sections in the statement of cash flows. Direct activities is not. It's a method of reporting the statement of cash flows, but it in of itself is not a section within the statement itself. All right, calculate the changes in each cash flow section. The operating section. So this is going to inform investors about whether the company is able to generate cash flows from its daily operations. And if it can't, it probably should just go out of business if it can't figure out how to do that or sell itself to someone else. What it's going to do is going to isolate daily operations from other activities, investing and financing activities. Those are useful, but you need to be generating cash ultimately from your operations. And it's going to follow this pattern. So we use the income statement as a jump off point because we have net income there. And then we're going to try to get from net income to cash flows from operating activities. So we kind of are starting with the assumption that net income is similar to cash flows from operating activities, but then say, well, in what areas isn't? Well, depreciation and amortization reduce net income, but they don't reduce cash flows. Right? We debit depreciation expense, credit accumulated depreciation. We don't credit cash flows. So we need to add them back to net income. We're going to make an adjustment that's an increase in the operating activity section. We're going to reverse gains and losses on asset sales. We're going to include those proceeds in the investing activity section. We're going to talk about that a little bit more coming up. And then adjust for changes in working capital, which are non-cash current assets and current liabilities. That's one of the most complex parts. So when we think about that one, if there's an increase in a current asset, it's going to cause a decrease on the statement of cash flows. And if it's an increase in the current liabilities, it's going to cause an increase on the statement of cash flows. Conversely, a decrease in the current asset will cause a increase in the statement of cash flows, and a decrease in a current liability will cause a decrease on the statement of cash flows. So if you can kind of commit this little grid of sorts to memory, that'll be useful. But to explain this a little bit more, this is definitely the toughest part of the statement of cash flows for people to kind of get. They're like, what do you mean? An accounts receivable increase decreases cash, because that's what this means, right? Current assets, accounts receivable is one of them. An increase in it decreases on the statement of cash flows. It's like, what does that mean? Well, you think about the journal entry. You're going to debit accounts receivable. You're going to credit sales. Income went up when you credited sales, but cash did not. All right. So you need to do a decrease on the statement of cash flows. This doesn't mean that when you sold on account, which is how accounts receivable goes, how they go up, that doesn't mean that when you sold on account, cash went down. It means it's a reconciling item between net income and cash flows from operating activities. When accounts receivable go down, this one to me is a little bit easier to understand. This is an increase on the statement of cash flows. Because when accounts receivable go down, it's when you debit cash and you credit accounts receivable. Your income didn't change. When you collect on accounts receivable, like debit cash, credit accounts receivable, there's no change in income. But cash went up, so we need to reconcile between income and cash flows by doing an increase to cash. When we're looking at inventories, all right, an inventory increase, if we go back to this little kind of grid right here, an increase in a current asset decreases on the statement of cash flows. Inventory is a current asset. If it increases, it's a decrease on the statement of cash flows. Well, why? Let's look at it. If inventory goes up, we debit inventory and credit cash. That doesn't impact net income, but we sure as heck used cash. So if we're starting with net income, which has no impact by purchasing inventory, but we need to get to cash, we got to show a decrease to cash. because income didn't change. Cash went down. And then when inventory decreases, now we're going to increase cash. Because when inventory decreases, we must have debited cost of goods sold and credited inventory. But that transaction itself, there's no impact on cash. There was an impact on net income. So to get back to cash flows, we need to do an increase on the operating activity section statement of cash flows. Income increased, but cash did not. I could just go on with these forever, but the accounts payable increase is going to be an increase on the statement of cash flows. If I go back to this grid right here, that is a current liability increase. It's an increase on the statement of cash flows. Increase current liabilities is an increase on the statement of cash flows. Go back to it here. Whoops, there we go. Why is that? Because we debit expense, credit accounts payable. Just think of like you're purchasing some services on account or something like that. Debit expense, credit accounts payable. There is a decrease to income, but you didn't pay cash. All right, so you need to add it back because no cash was paid. Net income is starting the statement of cash flows lower, right? Because this is a debit to the expense. So this decreased net income, it's starting the statement of cash flows lower. We didn't spend cash, so we need to show an increase. Income decrease, cash did not. But when accounts payable go down, think about the journal entry. We debited accounts payable, we credited cash. That didn't impact net income, did it? All right, but cash went down, so we need to show when a current liability goes down, a decrease on this statement of cash flows. And we could go through each and every current asset and current liability and kind of explain why that needs to happen if we wanted to, but I'll cut it off after these three. So let's look at an example. A new company provided $1,000 worth of services on account during the year. $600 was collected before the end of the year. They also accrued wages expense of $200. The company thus has $800 of net income, $100 of services, minus $200 of wages. They have $600 of cash. All right, they collected $600 of cash, $400 of accounts receivable because they sold $1,000 on account, collected $600 of cash, so they got $400 left of receivables. They accrued wages of $200. They also must have had retained earnings because they sold $1,000 on account and had so that was revenues of $1,000, expenses of $200, $800 of net income, so $800 of retained earnings. So net income is $800. Accounts receivable went up by $400. Those didn't increase cash. Wages payable went up by $200. That didn't increase cash. So once again, an increase in a current asset is a decrease on the statement of cash flows. An increase in a current liability is an increase on the statement of cash flows. All right, liabilities act opposite of assets. So now our cash flows from our operating activities is $600. And voila, this is your $600 there in your second bullet point above. So that's how we reconcile to it. Now the investing section on the statement of cash flows, this is going to tell investors how much the company spent on long-term assets or proceeds from selling long-term assets. Normally, companies are spending more on long-term assets than they're selling. Hopefully, if it's a growing company. The types of the long-term assets, cash flows from buying and selling property, plant, and equipment, and then cash flows from buying and selling stocks, and then corporate bonds, or quite frankly, government bonds are very common in this section as well. Companies might invest short-term in government bonds. So an example, a company purchased short-term investments of $300, sold short-term investments of $200, purchased equipment for $75. What is its cash flows from investing activities? Well, this one to me, like operating activities is the toughest. This one to me is a tick more straightforward. They purchased property, plant, and equipment, cash went down. They purchased short-term investments, cash went down. They sold short-term investments, cash went up. That they therefore had a decrease in cash flows from investing activities. Now onto the financing section. And we're going to kind of talk near the end like what is good, what is bad, how do we assess companies. In the financing activity section, we want to understand activities with our shareholders and our creditors. So the examples could be issuance of stock, repurchase of previously issued stock, treasury stock, issuance of debt and bonds, repayment of debt, not repayment of interest. That's considered an operating activity, and then payment of dividends. So at this example, a company issues stock, repurchases stock, pays dividends, issues bonds, and has repayments of bank debt. If we look at this example right here, what is this company going to have for cash flows from financing activities? Well, issuing stock is an increase. Repurchases of common stock is a decrease. Paying dividends is a decrease. Issuing bonds gives you cash. Repaying bank debt uses cash. So your cash flows from your financing activities, if you're this company, are $300. Now, gains and losses is a special topic. So when a company sells a long-term asset, any gain or loss is part of net income, right? Gain or loss, it's a component of net income, and net income is the first line in cash flows from operating activities. So we're kind of starting the operating activities section with net income, which might have some gain or loss in it, but selling assets, that's not an operating activity, that's an investing activity. So what we want to do is reverse out the gain or loss in that operating activities section and then record the cash proceeds from the sale in the investing activities section. So an example of this, a company began the year with $1,000 of land and $1,000 of common stock. It sells the land for $1,200. How does this impact the statement of cash flows? Well, net income is going to be $200 because it sold the land for $1,200. It had purchased it for $1,000, so it has profits or gain on the sale of land of $200. But we don't want to show it in the operating activity section. That's not part of our core operations is selling land, unless we're a company that basically buys and sells land, right? If we're a real estate company, then that would be possible. But most companies are not, right? Cash flows from operating activities, $0. Proceeds from sale of land is $1,200. You put the whole amount there. Your investing activities would be a positive. So they began with $0 of cash. The cash changed during the year of $1,200. We add up those, the investing, operating, and financing activity section, and there's nothing in financing here, so we end with $1,200. It's kind of an example of how that one would work. Moving on to the review question here. And sometimes I pause when I do this because my little screen recorder is up in my way. Review question 2. A company had $300 of net income and $50 of depreciation expense. Paid dividends of $17, purchased equipment of $42, wages payable decreased by $35. What are its cash flows from operating activities? So this one on purpose, I've included more things in here that are than are solely operating activities. So you have to pick out just the relevant things. And if you look at this one, you could pause it for a minute and see if you could get this one. If I look at it and you had picked 256, you put in purchasing activities probably in your computation, but that is in the investing activities section. If you put in 350, maybe you forgot the wages payable. If you put 385, maybe you did the wages payable backward. And if you did 315, that was correct. 300 of net income, add back 50 of depreciation expense. Wages payable went down by 35, so we have a decrease there. And we ignore dividends because that goes in the financing activity section. And we ignore the purchase of equipment because that goes in the investing activity section. Review question 3. If land is sold at a gain, which 2 sections in the statement of cash flows will require entries? What do you think? Which 2 sections require entries? Well, investing and changing cash balance really isn't a section. Nothing goes in financing. So the operating activity section is where the gain or loss is reversed, and investing is where you show the cash proceeds. Let's put it all together now and create a full statement of cash flows. And what you do is you just use items from the income statement and then the balance sheet, and you've got all you need for your statement of cash flows. So we have a balance sheet here. We've got the end of the year. You can see this company has $47,450 of assets and and the same amount of liabilities. At the beginning of the year, it had 46,500 of assets and liabilities and equity. Its cash went up by, you could just kind of eyeball that right now and see that it's 7 to 8 grand of a cash increase that way. The company has some net income, and it has a gain on the sale of land of 1,000. There's the proceeds from selling land, paid some dividends. So we've got all this information, and we got to put it on the statement of cash flows. So how we go through this one, in the operating activity section, we always start with net. I first oftentimes will just show the change. So I first kind of unveiled the change. What a little hint is we have to we have to basically look at each of these accounts and address them somewhere in our statement of cash flows. So the operating activity section, it starts with net income. We always start with that. Now we're going to look to see if there's any depreciation or amortization. And it doesn't say it specifically. So maybe someone's like, they must not have any, right? But look at this. Accumulated depreciation went up by $3,000. How does that happen? You have depreciation expense of $3,000, right? Debit depreciation expense, credit of accumulated depreciation. Now you're going to look to see if there's any gains or losses. And yeah, we do have a gain of $1,000, so we reverse it. Now you're looking to see if there's any current assets or current liabilities. Yes, receivables went up by $250. An increase in a current asset is a decrease on the statement of cash flows. We have inventory that went up by $200. An increase in inventory is a decrease on the statement of cash flows because it's a current asset. Other current assets, they went down by $100. That might be like prepaid expenses or something. A decrease in current assets is an increase on the statement of cash flows. Now we go to current liabilities. Accounts payable went down. So the liabilities is a little bit easier because you just follow the direction it goes. So the current assets, you have to go the opposite direction, but liabilities, accounts payable went down. Accrued salaries went up. Other current liabilities, they went down. All right, so it's a little bit easier to follow those through. And we see cash flows provided by operating activities, $5,400. Investing activities section. Now, if you looked at this one, just at first glance, you might not know how many are in there, but let's take a little peek here. We've got equipment that went up by $1,000. How does equipment go up? You purchase it. Okay, so equipment went up, we purchased it, and then it also said we sold land, and that means proceeds on the sale of land is $6,000. So that's the sale of land, and then short-term investments. One of the only things I'd skipped it right there accidentally. But normally the investing activity section is your long-term assets. That's a simple way to think about it. But if you have something like short-term investments, that is certainly an investing activity. That's probably the company had excess cash and just invested it in the short term in government bonds. It's probably like treasury bills, corporate bonds that have maturities of less than a year, stuff like that, just to get a little better interest rate in the short run. And their cash used in investing activities, they actually generated $4,700. Financing activities, long-term debt went up by $300. It means they must have issued it. We can look at other things. Common stock went up by $150, means they must have issued it. And then dividends paid, $3,300. That is going to be a decrease, the statement of cash flows. So financing activities, cash used there, $2,850. We sum up those three sections and we see that cash changed by a positive $7,350. It went up by $7,350. That's kind of the difference up top here. And that's the reconciliation between our beginning and our ending cash. So that's kind of putting it all together. And real companies, it's a lot of it is that straightforward. Now they might have some unique accounts that you have to dig into more detail, and there's certainly some special topics that I haven't gone deep enough into that way. But that's just the principle of how they put it together. And the beauty is, once your income statement and balance sheet is done, boom, you just bang this out. It can be done very, very quickly. So the review question number 4, the increase in cash is the sum of what? If you look at these options right here, increase in cash is the sum of, It's not sale of long-term assets. That's in the investing activity section. It's not operating and investing activities. We're missing financing there. It's not beginning cash plus ending cash. It would actually be the difference between those two. Ending less beginning. It's cash flows from operating, investing, and financing activities. Well, to interpret the statement of cash flows, as we're getting later on in this lesson here now, cash flows from operating activities. For newer companies, this might be negative. Honestly, it's usually frequently negative because they're expanding. They probably have a lot of administrative expenses compared to their sales. They have a lot of research and development. They have a lot of marketing. So this isn't a bad thing that cash flows from operating activities are negative right away. It's just kind of to be expected. All right. For mature companies, it should hopefully be positive, right? And then higher than net income as they're adding back depreciation and amortization. That's the most likely thing for a mature company. Higher than net income because adding back those non-cash depreciation and amortization. If you got a mature company that is not generating cash flows from operating activities, that's a bad sign. Now, if there's large decreases, you also can investigate it. Like if there was a huge increase in inventory, it's like, why are they building up so much inventory? Are they going to have problems selling that? There's companies that build too much. Or if the accounts payable starts skyrocketing, it's like, why aren't they paying their suppliers? Is there a cash crunch? Are they afraid they're going to run out of cash, right? You can use this section to ask questions. Investing activities, I usually think it's going to be negative for most companies out there because new companies are certainly investing and to kind of support their growth. But frankly, established companies are normally doing some sort of investing as well, just as they're slowly adding property, plant, and equipment. So if this section is positive due to the sale of property or investments, you want to make sure that the company's kind of doing that strategically and not just trying to sell their property, plant, and equipment to stay afloat. Because if you sell all your property, plant, and equipment to stay afloat, you got nothing left to run your business, right? So that's going to be that would be a bad sign for a company. And then the financing activities section. Newer companies, I usually think of larger inflows because they're issuing stock, borrowing from the bank, issuing bonds. Mature companies, I usually think of as outflows because they have a lot of cash from operating activities. They usually have a lot more cash from operating activities than they need to invest. So they're basically paying dividends and repurchasing stock. Okay. But a big activity can sometimes have inflows in the financing activity section if they need it to complete a major acquisition. And we're going to take a peek at that in the final example here with Amazon. So this is going back to 2017, and you'll see why I'm dating this one a little bit. But Amazon, this is how they were just kind of touring along. Now they're over a $500 billion company. This is back in the $170 billion days. They had growing sales. They had some operating income, $4 billion. All right. So nothing, it's the sign of a growing company. Now, if we look at their balance sheet, we looked at cash and marketable securities and inventory and accounts receivable. They're all growing a little bit, but we see huge spikes in property and equipment, goodwill, other assets. And we're like, wow, what's going on here? If you go over to the liabilities section, accounts payable, accrued expenses, unearned revenue, they're growing somewhat. Their current liabilities are growing somewhat, but not crazy growth. But look at long-term debt growing by $17 billion. Look at additional paid-in capital growing by $4 billion. You usually don't see an established company having an increase in common stock or additional paid-in capital. It's like, why are you issuing shares? You're Amazon. You have over $100 billion worth of sales, a few $1 billion of operating income. What's going on here? Well, you can dig into the statement of cash flows. And I just pulled 4 line items out of this statement, and it's because it's a pretty long statement. We can see that first line, cash provided by operating activities, pretty healthy, right? $18 billion of cash in 2017 from operating activity was similar to 2016, where they generated $17 billion. Investing activities, they're buying more and more property, plant, and equipment, right? We see a nice steady increase. But look at these 2 sections here. Acquisitions, they didn't do much in 2015 or 2016, but they did $14 billion worth of acquisitions almost in 2017. And then look at this proceeds from long-term debt, $16 billion that they're increasing long-term debt by in the financing activity section. And if I'd had a little bit more room, I also would have pulled in there the issuance of stock. But what happened? Well, that was back in June of 2017. They announced that they're going to buy Whole Foods for $13 billion. So despite the fact that they were generating a lot of cash from our operating activities, they were using some of it to buy more property, plant, and equipment, but they needed to issue debt and issue stock to fund this big acquisition of Whole Foods. Last review question here. What would be the most concerning for a well-established company? A decrease in cash flows from financing activities or investing activities or operating activities, or an increase in cash flows from an operating activities? Well, it wouldn't be a decrease from financing. You kind of expect that. They're paying dividends, repurchasing stock, maybe repaying some debt. Investing activities, no, they're just growing, right? Increase from cash flows from an operating activities, that's not concerning. That's expected. But if they're decreasing cash from operating activities, it's like, wow, what is going on? Well, key takeaways here. Statement of cash flows used by investors to help understand how a company is generating and using its cash. We break it up into the operating, investing, and financing activity sections. In a healthy company, we usually have positive cash from operating activities, negative cash from investing activities as it continues its growth, and then negative cash from financing activities unless it's doing something unusual. That's what we got. Thanks for tuning in to Lesson 11.